Hello everybody, this is the second video that I'll be doing on the case studies from the CAIE paper 2 examination. This time I will be doing May-June 2018 variant 2. So let's start by reading the passage together. It's called Thai Economy's Prospects Improve. The first table, 1.1, says total expenditure in Thailand by category 2014. And the various categories of expenditure are uh, we have here household consumption, capital goods, government consumption, exports, and imports. And if you notice here, the biggest category of spending is exports with 280, followed by imports of 253 US dollars in billions. Now read the passage together. It says Thailand's economy shows improved health. The latest figure shows that Thailand's economy grew by 3.5% in the second quarter, putting it on track for 3.3 to 3.5% growth for the whole of 2016. Thailand has managed to boost its growth after several quarters of disappointing performance by increasing public sector investment in several large infrastructure projects, including roads, railways, and airports. These projects will run over the next 3 to 5 years and are worth over several hundred billion baht, Thailand's currency. It is hoped that this public sector investment will encourage the private sector to increase their investment spending. In addition to increased investment, the Thai economy's growth is being boosted by recovering private consumption due to increases in farm prices, which are crucial to household purchasing power. So farm prices, purchasing power has gone up, as well as a strong tourism sector. Regarding the export sector, which remains the biggest engine of growth, the outlook is still uncertain, but the negative impact from China's economic slowdown appears to have stabilized with a Chinese growth rate of around 6.6% per annum. So this first extract was basically about how Thailand's economy is improving and growing. It says that it's set to grow for about 3 to 3.5% in the year. And they're saying that this growth has come from a number of different factors. The fact that the government is spending more on infrastructure projects and that they think this will encourage other private sector investment as well. And they said that there's been an increase in private consumption because farm prices have gone up, and also the tourism sector has improved. And this tourism may have improved because China was previously slowing down, but now their growth rate is also improving, and maybe there's a lot of visitors from China. So this helps the tourism sector in Thailand. The second extract says Thailand's tourism industry continues to grow. So it's all about the tourism industry in Thailand. The Thai tourism industry is projected to record international visitor arrivals of 16.67 million. So in international arrivals between January and June, which will be up by 13% over the same period of 2015. Projected earnings are estimated at 824 billion baht, up 17%. The top three markets in terms of tourism receipts are projected to be China, Malaysia, and Australia. China is now by far the largest source of visitors, for but there has been a resumption of growth from Russia and Thailand's neighboring countries of Cambodia, Laos, and Myanmar. So the second extract is all about Thailand's tourism industry and how it's improving, and it's up by 13% compared to the previous year, 2015. And the most visitors are coming from China, Australia, and Malaysia, and China is the biggest source of visitors. But Russia and Cambodia, Laos, and Myanmar are also starting to visit Thailand a lot. So this is a big source of income to the Thai economy. So now let's take a look at the questions. All section A questions add up to 20 marks, including this one. So let's attempt them now. So the first question says, calculate the level of aggregate demand in Thailand in 2014. For this, we need to go back to the table and see the data they've given. So The first table, and the only table actually, table 1.1, shows total expenditure in Thailand by category 2014. The category of spending are household consumption, capital goods, government consumption, exports, and imports. Does this look familiar? Yes, that's related to AD. Because aggregate demand, as we remember, is equal to consumption plus investment plus government spending plus net exports, which is X minus M. And that's exactly what they've given us: household consumption, capital goods, which is investment, government consumption, and exports and imports. Which is why total level of aggregate demand will be equal to 243 plus 98 plus 69 plus 280 minus 253, which gives us a value of 437 billion US dollars. So let's look at the second part. It says, in which category of expenditure would the various infrastructure projects be placed? For that, I want us to look back at extract 1. And the infrastructure projects that they're talking about is where the government has spent more on roads, railways, and airports. But this is still public sector investment, and the key term is investment actually, because the different categories of spending are consumption, investment, government expenditure, or net exports. Anything that's considered an investment will come under the category of investments, right? So either in your answer, you will write that this was capital expenditure or that it falls under the category of investments. So that's exactly what you'll write for the second answer. Uh, the various infrastructure projects will fall under the category of capital expenditure or investments. To clarify, the categories that they're talking about are the components of aggregate demand, and which component do the infrastructure projects fall under? And the answer is capital expenditure or investments. Let's move on to the second question. It says, explain how a fall in the rate of interest would be likely to affect expenditure on consumption and exports. So the rate of interest can be looked at in two ways. Interest rate is the cost of borrowing, and it's also the rate of return. Now, this is because if you're a borrower, interest rate becomes the amount of money that you have to pay back. So it becomes the price of borrowing money, right? Or the cost of borrowing money. Whereas if you're someone who lends money, for you, it's the money you get back. So it's the amount of money you get back after lending someone money. Okay? So, for these very reasons, if the interest rate were to fall, there would be less of an incentive to lend money or save, and more of an incentive to borrow money. And so, for these very reasons, consumption would go up and savings are likely to fall. Part 2 talks about the effect of a falling interest rate on exports. So when the interest rate falls, again, interest rate can be considered as a rate of return. So if the interest rate falls, the demand to invest in that country will also fall. Therefore, there'll be less hot money flowing into the economy. Hot money flowing in will fall. This means people who were previously investing in this country are now going to invest elsewhere, and there'll be less demand for that currency. So, this will lead to the demand for the currency to fall. As well as this, more hot money will be flowing out of the economy. Hot money flowing out. So this is in and this is out will go up, and therefore the supply of currency will rise. This means that people in this country will also invest elsewhere. And if they're investing elsewhere, the supply of their currency in the foreign exchange market will go up. So if we see both of these effects in the form of a diagram, the demand for currency is falling. So it falls from D1 to D2. And also the supply of your currency is rising from S1 to S2. Okay, so D1, D2, and S2. And this leads to a lower rate, uh, lower exchange rate. So your exchange rate has fallen. It just so happens that the quantity has not changed, but it may. But one thing for certain is the exchange rate will fall. Now, now that the exchange rate has fallen, what will this do for the demand for exports? Demand for exports will rise because the price of exports have fallen. Whereas if your exchange rate falls, your demand for imports will fall, right? Because importing materials or final products from abroad have become more expensive, and therefore the demand should fall. But this is dependent on a very important factor called elasticity, right? Depends on the elasticity. That's what I'm going to write. Depends on the elasticity. So this element of the demand for exports rising and the demand for imports falling is dependent on whether together these are elastic in nature. So PED should be elastic. Sorry, elastic. This is actually called the Marshall-Lerner condition. It says that in order for an exchange rate to have an effect on demand and imports, there should have an elastic demand. And you don't need to explain the Marshall-Lerner condition in too much detail, but you should mention that the demand together should be elastic. The next question. Explain how changes in any three demand factors might account for the greater rate of growth in numbers of visitors into Thailand from China than from other countries. So, what are the factors that influence demand? Well, the biggest one and one of the main ones is income, right? And within income, you have inferior goods and you have normal goods. Yes. You also have price, but this is more of a movement along the curve versus a shift. And then we have other related products, right? Within this, we have um, substitutes and we have complements. Then we have the distribution of income, okay? This is talking about how evenly distributed is the income in the economy. We have expectation of future prices, okay? We also have taste and fashion. So these are all the factors. So let's discuss each of these. We can say maybe the income in China has gone up, which could be linked to the fact that the Chinese economy is growing again. It was slowing down, but in the passage, it does say that the economic slowdown in China has stopped being such a problem. So the income in China may have gone up, which is why they have more purchasing power. And because traveling is a normal good, they are more inclined to visit Thailand after the income has gone up. We can also say maybe the price of traveling has become relatively cheaper. Maybe the Thai government has had some special offers and encouraging tourism in the country is important. So they reduced the prices, and people from China are now more able to go to Thailand. Uh, we could also say that maybe traveling to from China to Thailand is not as not as expensive anymore. And because we are comparing other countries, it could be more expensive for other countries to visit Thailand versus people from China. Other related products may not be so relevant to this question. We could talk about how traveling, compared to some other leisure activities, become more popular. Distribution of income could be an important one. Maybe the distribution in income has become more even as compared to other countries, and therefore more people are now traveling. Maybe the expectation of future prices could be relevant in the sense that because the Thai government or the Thai economy is improving, people are expecting that the prices later on of traveling might be expensive. But currently, traveling to Thailand is more feasible, so people are taking more holidays. We have taste and fashion. This could be relevant because maybe Thai's become a more happening place for people to travel to, and it's nice in the summertime, so people are traveling more to Thailand. But the key thing to remember is that whatever factor that you choose, you should make some sort of comparison to other countries, saying why is it that Chinese people are traveling more to Thailand versus people from other countries. Now, there's a lot that you could say, and there is no wrong answer, but it just should make sense. Okay? But that comparison needs to be made. The last question. Discuss whether Thailand's government should be concerned that export and import spending represents the highest proportion of total spending in Thailand. The first thing that I would like to do is explain that the exports minus the imports give us the balance of trade, right? And this is a part of the current account. So the question is, should we be concerned that the balance of trade makes up one of the biggest portions or is the highest portion of total spending in Thailand? Since this is a discussed question, I like to split the argument into two sides. One talking about why it would be a cause of concern, and on the other hand, why it wouldn't be. I want to discuss the positives first. Okay? The fact that we are Thailand is exporting quite a bit. What are they exporting? They're focusing more on the tourism industry, right? Tourism is considered an export because you're exporting an external service to foreigners who are coming into your country, and which is why it's considered an export. And this is increasing, and therefore the economy will grow, right? The economy will benefit from this growth in tourism. Uh, as well as this, if there's more export, it gives us more opportunity to import, which is what's happening. And this can be argued to raise the standard of living in the country because products and services that were not available in the country locally can now be imported in. This all is indicative of the theory of comparative advantage, which says that sorry, why did I erase that? The comparative advantage theory says that if you're benefiting from free trade, then that's good for an economy. You could also mention that people in the exporting industry in Thailand or in the tourism industry will also have a high rate of income. They'll consume more. This will stimulate more growth in the economy, as I said. So these are all the positives of a growth in more trade. On the other hand, there are some negatives associated with this high spending. So, have we not heard of the phrase, don't put all your eggs in one basket? This is that kind of scenario here where they're saying depending so much on export and import spending might be a scary thing for an economy. Because if there was a negative world event, right, that could lead to a decrease in demand for exports, right? And because it makes up such a significant portion of our spending, it could have a significant impact on the economy, right? It could have a horrible effect on the overall aggregate demand in the economy because if exports fall, meaning tourism goes down, So I'm going to specify here, I'm talking about tourism, for example. If tourism was to decline, it would have a major impact on income in the economy, spending would fall, and it would just slow down the entire economy. So the point is that we should never have too much of a high dependency on only one component of spending. So that's the end of this case study. I hope this was helpful. Please stay tuned for more videos coming soon.